before we get started, full disclaimer here, I am not a licensed financial advisor. This is educational information only. Now, you may find that I give some of my opinion based on some charts and analysis, but I do not give advice to your personal crypto portfolio or how you respond to the market. I cannot predict the future, so I'm giving you tools today to do your own research. You can find She Nodes active on X. Please get out your phones now and give us a follow for market updates and macro details. We're also on Instagram, and if you're interested in getting involved or have questions, please send us an email at shenodes@proton.me. Now, this presentation is really bottom line if you have capital at risk or plan to have capital at risk and you need an exit plan. So maybe you bought some crypto and forgot about it, or maybe you've been scaling in for years, or maybe you're just on the sidelines now and want to learn more on how to take profit before you enter. So this presentation today, I'm going to give you the tools to spot some market trends, teach you how to take profit, and then most important, hope to have you build a personal exit plan. I love to start with this chart, and this is top global assets by market cap. And this rank compares Bitcoin to everything else. So stocks, metals, commodities, it's all on one scale. Now think of this as your bird's eye view of how Bitcoin is doing. And you can see it as number 7 there. But just think of this, just 2 years ago in 2023, Bitcoin was ranked at number 12. Why is this chart important? Well, the size of market cap matters. It hints a little bit at durability because bigger market caps usually mean more participants and deeper liquidity. I also think it's an adoption barometer. So if Bitcoin climbs the rankings over time, this is maybe a simple sign that more capital and institutions are showing up, like ETFs and custody funds. And then also, it's a risk management cue for you and your investments. So if big ranks drop or there's gains, it really prompts you to recheck your portfolio and what you're invested in. So bottom line is, this is really a leaderboard telling you if Bitcoin's story is getting bigger or maybe just louder. So keep an eye on this. Now, first, some definitions. You will hear me likely say bull and bear throughout this presentation. And for those of you that don't know, the bull market means that prices go up, there's investor confidence, and you can think of this as the bull with the horns charging up. And the bear market is when the prices fall, the confidence is low. Think of this as swiping down like a bear's claw. Now, here are some tools you can use for your own personal research to analyze the market. Now, these are all free beginner tools and easy to access. You can either access it on a web browser, or each of these actually have apps that you can download onto your phone. So the first one there, CoinMarketCap, and then next to it, CoinGecko. These are your ways to analyze the market very easily with coin rankings. It also shows charts for Bitcoin dominance and historical charts. TradingView allows you to access professional charts. You can build and customize indicators. There is a free version. And CryptoBubbles is kind of fun. This gives you a crypto coin performance in a bubble. It allows you to really scan the market quickly and narrow your research with other indicators. Now, one of my favorite sayings is, the bull climbs the stairs, the bear jumps out of the window. Now, you've probably heard buy low, sell high. Sounds simple, but in reality, it's not. Especially in crypto, because uptrends usually grind for months. It is very boring, months to years, but the tops can unwind really fast. And then in the past cycles, parabolic blow-offs often only ran 6 to 10 weeks before sharp reversals. And then as quick as 2 weeks, the bottom drops. Hence, as the bear falls out the window. I want you all to write this down. You are exit liquidity. The smart money, the institutional buyers, are typically selling high and making a profit off of you when retail is buying high and losing when the market drops. So how does retail become exit liquidity? Well, maybe you're buying those high breakouts late with no plan. Maybe you're ignoring some warning signals, which we'll talk about today, when the market is super frothy. Or maybe your size is too big. You put too much money in and you panic, exit out of the market on the first drop and take a loss. Let's go ahead and look at some market indicators so you're not that exit liquidity. Now we're going to look at 5 market indicators. There are plenty more, but these 5, when used together, become a powerful tool to assist you in researching how you get out of the market. You don't have to be a pro at reading charts or technical analysis, and a lot of this you will find is common sense if you use your research and not your feelings. Let's talk about the first one, time-based historical patterns and the Bitcoin 4-year halving cycle. Now, this is probably one of the best time-based historical patterns, is Bitcoin's 4-year halving cycle, because it's written in its code. The 4-year halving has been a pretty reliable clock for crypto's boom, rise, and bust rhythm so far, but we don't know if this will repeat or rhyme again in this cycle. The Bitcoin halving cycle is really a crucial event that occurs every 4 years, and that's when the reward for mining new Bitcoin blocks is cut in half. Now, the most recent one, the halving, was April 20th of 2024, and that dropped the rewards to 3.125 Bitcoin per block. Now, this mechanism is designed to control the supply of Bitcoin, making it more scarce over time. And we know that only 21 billion Bitcoin exist. So I'd like you to think of this like the Olympics for Bitcoin, an event that many anticipate and prepare for. And this cycle significantly influences Bitcoin's price, creating predictable patterns this far. Now let's calculate this. We're about 16 months into the post-halving phase, the window where prior cycles often peaked at around 12 to 20 months after the halving. So if you base the top solely on this, then that would indicate the top would be sometime in Q4 of 2025, or if the cycle stretches long, it could be Q1 of 2026. However, some argue that these cycles are done and won't play out because of more adoption, so we will have to see how this plays out. Now, how many of you remember the game Chutes and Ladders? Well, basically, if you think about it, this is the kindergarten version of Wall Street. The ladders going up are those bull runs and solid setups, and the chutes are the bear markets and your bad bets. Now, we could change this game into the Wyckoff phases. Now, Richard Wyckoff created this in the 1920s for Wall Street to basically decode how smart money manipulated markets. So think of this as maybe he reverse engineered the stock market con game in the 20s. It maps really well in crypto, but doesn't always follow it. And it doesn't follow inside the 4-year cycle completely. But there's some things we can learn from it. Accumulation is the bottom range. This is when the smart money absorbs the supply and the base forms. This is typically 12 to 18 months after. And in this cycle, the bottom, if you remember, the bottom was during FTX in November of 2022. And then accumulation was acquired in 2023. And I put the Bitcoin price there so you can kind of see Bitcoin was 25 to 30K in 2023. And then comes the markup phase. So this is the trend up phase where it breaks out of range higher. You have higher highs and higher lows, and it's considered the bull market. You can see here that Bitcoin hit 73K last year, and then most recently Bitcoin hit 124K. Next, you have the distribution phase. This is where the professionals unload and exit the market, and retail is buying in. And last is the markdown phase, which is the bear market. All right, the next market indicator is sentiment and retail signals. Now, sentiment refers to the market's mood, and moods influence price movement. When retail starts buying into crypto, aka I'm talking about you, the smart money is selling. These are your exit signs to get out. Number one, the Fear and Greed Index. This is a quick pulse of crowd emotion and market mood. You can find this on CoinGecko and CoinMarketCap. The scale is 0 to 100, and 50 is neutral, and anything higher than that is greed, anything lower is fear. But you want to look at the extremes. So typically, if it's over 80 with extreme greed, you may want to consider getting out or exiting out. And less than 20 is a great time to buy when there's fear in the market. Next is Google Trends. This is your retail radar. You can use it to spot retail arrival with top searches. So you can just type in googletrends.com and put searches in like how to buy Bitcoin, best crypto to buy, Coinbase. And then when this spikes, it's a sign that retail has come back. So look at that trend. A lot of times you can have a breakout if you narrow it down to the 7-day average. And then if it's more than 2 times the 90-day average, it typically means it's at all-time highs. Next is the Coinbase App Store rank. This is on X, so you can follow this account. And this tracks Coinbase's app in the store, so how many retail is downloading the app. And once these downloads hit peak, it means that retail is coming back to buy crypto. So a simple rule is typically, I think I checked, it was like 329 in the last week. Usually if it's in the top 100, retail's kind of stirring. Top 25, retail's waking up. And if it's the top 10, it's probably time to exit out. It's probably the euphoric stage. Next is the Rolex Market Index. And yes, this is true. There's actually a Rolex market indicator. It tracks resale prices across popular Rolex models. And basically, when risk assets boom like crypto, people want to spend their profits on shiny things. So you will see this Rolex chart ripping at the end of the market. And the last red flag is the gossip test. And it's time to get out of the market. When you start hearing people that never talk about crypto suddenly won't shut up about it, your coworkers, barber, family dinners, this is your last indicator that it's probably time to take some profit and get out of the market. Next is market structures. The crypto market dominance and market structure metrics, dominance is an important one. Again, you can find this chart on CoinMarketCap or CoinGecko under the Bitcoin dominance chart. Now, market dominance just means how much of the total crypto market cap belongs to one coin. And what we found is this follows a very cyclical pattern that has been consistent for each cycle so far. So number one, people trust Bitcoin first. So new money enters through Bitcoin. So Bitcoin dominance goes up and stays up for the majority of the market. Usually it's greater than 60%. Then mid-cycle, Bitcoin dominance goes down, less than 60%, and investors start to rotate into Ethereum. And then last, late cycle, Ethereum dominance goes down. Others, which is your alts or your altcoins, go up. And this is when altcoins pump. Capital flows into smaller alts, and these people are chasing huge gains. They get very, very greedy. This is when you'll see Bitcoin dominance drop at all-time lows, which is less than 50%. This is a good indicator to get out of the market. Now, if you look at this chart here to the right, you can see a trend. So the orange is Bitcoin, the bright blue is Ethereum, and then The lighter blue is others. And if you look, you can see a trend. Bitcoin dominance peaks, sharply drops, then Ethereum peaks, sharply drops, and then others, all the other coins peak and then drop, and then the whole market drops, cueing the signal as the start of the bear market. So, in simplest way and form, Bitcoin dominance shows who is holding the crown. And then Bitcoin rules at the start with a power shift to ETH. And finally, the smaller coins get their moment before the market crashes and everyone runs back to Bitcoin and the cycle repeats itself again. Again, this is how every cycle has played out. Doesn't mean it will play out again because this is a different market, but these are previous market indicators. Another way to look at this is the path to alt season, and many of you may have seen this. This was created by Binance, which is a centralized exchange. They made this schematic that showed how capital rotates into pretty predictable waves during the bull market. And so it looks something like this. Phase 1, Bitcoin. Bitcoin pumps. This phase pulls in that new capital. The dominance rises, and then the dominance drops, and then Ethereum outperforms. The narrative shifts from Bitcoin to Ethereum. And then once you see Ethereum outperforming, then it'll switch to the large cap alts. So coins like Cardano, Solana, BNB, XRP, you're going to see these coins begin to rally. And then it's the risk on phase, our full on alt season. This is when capital floods into more of those speculative, smaller projects like meme coins, AI, gaming. This is the true alt season with amazing profits and blow off tops. Gains go parabolic. You can see, 100 to 1,000x return. But again, this has been the historical pattern for every cycle this far. It doesn't mean it will happen like this in 2025, 2026. The problem is now Bitcoin is eating more dominance due to a lot of institutional buys, keeping up the price. And there's a lot more coins on the market now. It's so saturated. There's over 6,000, and that really dilutes the profits. And also now liquidity is kind of tight, right? Because of the macro environment, interest rates, people don't really have as much money this cycle as they did in the previous ones. All right, next is on-chain behavior. And the nice thing about crypto is that this on-chain information is all free and accessible on the blockchain. So a lot of the research you can do online, and it's not manipulated. So whale activity, whales are large holders of Bitcoin, and some say greater than 1,000, some say greater than 5,000, but you want to pay attention to what the biggest Bitcoin holders are doing because they can shove the price around easier and manipulate the market. And think about this picture, like a blue whale in a kiddie pool. These can be early holders of Bitcoin, and a lot of times they're institutions or exchanges that are moving money around. Or you can call them the smart money because they know a lot more than we do. You can follow a whale tracker on X for whale alerts that'll tell you with big buys and sells of whales. Arkham is also an exchange that also tracks whale wallets. And there's other whale wallet charts that you can look at for free on Glassnode and CryptoQuant and other websites. Next is dormant wallets, and dormant wallets just mean those are the hodlers. Those are the old coins, like the Bitcoin that haven't moved in a really long time. A lot of them are on a hardware wallet and they've held and not sold. So these wallets start waking up, and basically the long-term holders take action by selling a profit. And you can see this on-chain sell-off. Basically, in order to sell, you typically cash out to your bank account on an exchange. So all you really need to see is those exchange wallets going up, showing that people are selling. And then that would be an indicator that, it's time to take profit. Next is ETF flows. This, if you don't know, Bitcoin is Accessible now through exchange traded funds and brokerage, and now most recently 401k and retirement accounts. But money is moving in and out of spot Bitcoin ETFs like BlackRock and Fidelity. And again, this is on CoinMarketCap. You can look at these charts on a lot of websites. But the basic is if there's inflows, investors are buying ETF shares. If there's outflows, investors are selling. So think about this as a thermometer for big money. And you could look at the total net flows and then track it. Many green days in a row, there's buyers in charge. There's many red days in a row, they're selling. And the last is the macro catalyst. Now, the macro catalyst, think of them as the big hoses that either spray liquidity onto risk assets or suck it out, which makes the price dump. Bottom line is more liquidity or money equals more risk taking. This is the final market indicator that sets the stage for setups in the market. So the DXY is the US dollar index. And really, that's a report card of how the dollar is doing compared to other currencies like the euro, the pound, the yen. And the DXY and Bitcoin are inversely related, if you think about it, because when the dollar goes up, meaning the dollar is strong, Bitcoin goes down. But when the DXY goes down, Bitcoin goes up and the dollar is weak. Next is the M1 global supply. Now, this is liquid cash sitting in checking accounts ready to spend. So it doesn't count your savings, doesn't count bonds or stocks. So spendable liquid money. So when M1 goes up, remember more liquidity in the market, Bitcoin and risk assets go up because of more spending power. And last is policy and rates. When interest rates are high and there is quantitative tightening, it shrinks liquidity. When quantitative easing starts and interest rates drop or the feds print money, it brings in more spending power into the market and people buy risk-like assets like Bitcoin. Okay, so now that we went over market indicators, I'd like to make sure you are aware that everything is out, completely out of the window, if there is a black swan event that occurs. And a black swan event is a true surprise that you can't predict, and it hits with massive impact. These are some examples here, like the 2020 COVID crash, any kind of war or banking failures. The FTX collapse was one of them. When these black swan events happen, there is fear and panic. Everything sells to raise cash, and crypto and risk assets bleed. The bottom line, the reason why I want to bring this up is you can never predict this. You need to design your portfolio to survive it. Okay, so we went over the 5 market indicators. Let's analyze the market today based on our indicators. Now, looking at the time-based historical pattern in the 4-year halving cycle, we said the last halving was April of 2024. So as of today, we're about 494 days since the historical top, which arrive around 12 to 20 months. So we're likely in between the markup and distribution phase. And, we're looking at, if we base these patterns on just the time in previous cycles, Q4 of this year, maybe Q1 of next year. But again, it doesn't mean that this cycle will be the same. It's just something to look at. Sentiment and retail is currently about neutral right now. I posted this or put this in a couple of days ago. Retail still needs to wake up. On-chain behavior shows no real spike in whale activity, but there is a slow uptrend. And you can see that possibly for a macro catalyst event, there's possible quantitative easing in September. So basically, we're not at the end yet. This isn't peak mania, and this is just healthy mid-cycle behavior based on these indicators. All right, so let's get into your exit playbook. I like to call it beating the bear, or the bear market, that is. So this is your thing. Exiting the crypto market is just as important as entering it. Historically, during the bear market, assets can lose up to 80 to 90% of their value. Without a plan, most investors give back the majority of their gains. That's why we're using this 4-step exit playbook to protect profits, reduce risk, and position yourself for the next cycle. Now, remember that profit isn't real until it's taken. Remember that this is an emotional trap. There is a lot of euphoria at the top, and you think the price is going to go up forever, but it does not. There will be a bloody bottom. And our goal today is to really learn that repeatable framework for profit taking. All right, so let's start with step 1, which is your portfolio blueprint. This is going to be the most time-consuming and challenging. This is your portfolio tracker. This is where you're going to build your crypto map before all that chaos hits. This means you are writing down every single crypto coin that you have, that you've bought, and you're going to come up with a plan. So you can do this a couple ways. You can start by using either Google Sheets or an Excel spreadsheet and make it from a blank and create it on your own. You can also use CoinGecko, which I referred to today. They do have a free template, and they have an API that you can add to it that changes the prices. It's kind of nice. You can look online and follow the direction on how to download it. All right, so below here is an example portfolio where you can follow along. This is an Excel spreadsheet that I made. And first is your cost basis. You need to find your average buy-in price for each coin. For example, if you bought Bitcoin at different levels, know your average price was $42,000, so you can hit your price targets. If you do not have a cost basis, you have no way to measure your profits. So this is number 1 step, very important. Next, you want to try to set your base, bull, and bear price. And these are your price predictions. This will give you a better idea of when to sell. For example, you could say your bull case could be 50% from your base, your bear could be 50% low from your base, and you could be 10% lower or higher at your base. Next is your conviction ranking. What is your horizon? Is this a long-term hold, or will you be selling? Are you going to sell 100% of the cycle? Or, for example, you don't have to sell all of it. If you believe that Ethereum or Bitcoin will continue to rise, you could take 80% profit and leave 20% on the table. Next is how are you going to take profit? Will you roll some into Bitcoin? Will you cash out into your bank account? Or will you roll over to stable coins for the next cycle to buy low? And last is your final plan based on your market triggers. This is your plan. These are based on the market indicators that we just went over. So for example, if you're following the path to alt season and you're looking at Bitcoin dominance, and you say when Bitcoin dominance drops below 50, you're going to take profit. And then when the dominance of ETH drops, you're going to take profit. And so there's a lot of market triggers that you could go by, and you could pick all of them if you want. Again, this is education and not financial advice. So use your goals, your time horizon, and risk tolerance to set the plan. Step 2 is to set your profit-taking strategy. The hardest part isn't really the math, actually. It's taking the profit. There's that psychological level where you don't want to take profit. But there's 2 options I'm going to go over. Option 1 is that you can try and time the top and take your exit. If this is worth the risk for you and you land on the top or close to the top, this is great news for you because you've reached the top. But if you lose, the downside is you miss out and you lose up to 80, 90% of your profit. Timing the market is really, really hard unless you're a crypto analyst and use technical analysis and study the market every day. And even the top traders say that they've missed the top. The biggest regrets that I have heard is number 1, taking profit too soon, and 2, taking profit too late. Option 2 is a risk management option. It's to ladder out of the market. And what does that mean? You're pre-planned step-by-step selling. So as the price goes up, you're walking down the steps to exit one step at a time, not tripping, just slow and steady. Now, this works because you're using data and not emotion, and it protects your wins. So if you're too early or too late, you still kind of capture that middle and it reduces your risk ratio. You still use those stairs to capture profit, but you don't have those big cliffs where you lose. Now remember, you can use your market indicators to determine that profit taking. And so there's all kinds of laddering that you can do. So for example, we talked about the market trigger laddering for the Bitcoin, Ethereum, and alt season dominance, or you can hit your price targets. So for example, you're going to sell X percent at 50% profit, X percent at 100% profit, 200% at next profit until the price reaches blank. So you have your price targets. The other thing you can do that is probably one of the easiest is to time base it in DCA out. DCA, dollar cost average. Typically, most people dollar cost average in. When they buy crypto, they put a percentage down, once a week, they put that percentage down. You can do that when you're exiting out of the market. So every Friday, you're going to take a percentage off until it's completely done. So you can pick a bunch of your buckets and then you can assign a percentage of each area. You can also execute it on a daily or weekly basis. Find what works for you. It's going to really depend on how much attention you pay to the market and what you're comfortable with. The next is to execute and monitor. Now, you can make these trades and exits automatic. You don't need to babysit the screen. You can automate with most exchanges. For example, if you use Coinbase to automatically sell your orders when they hit a target price, you could hit limit sell. So you hit limit sell and you take profit at a price that you pick. And then also you can do what's called a stop loss. So basically you have a safety net that it sells if the price drops to the floor or below. Then you're going to sell either when it hits the high or hits the low. And it really helps you prepare, if you're not looking at the market, to still get that profit and not lose out. Also, you want to make sure that you really stick to a plan that you have, and then you record and review it. Keep your logs of what your plan is so you can evaluate it for next year. And then step 4, where do profits go? Do you want to cash out from an exchange to your bank account and buy a house, a car, or go on vacation? Do you want to convert something into USD or a stable coin? Now, for you, those of you that don't know, a stablecoin is a tokenized crypto like USDC or USDT, and it's designed to stay near a dollar. So it's less volatile and the price is pretty stable. So it helps you lock in your gains, but it lets you hold into the next market to buy additional crypto, or you can cash it out. You could also convert your crypto to Bitcoin or Ethereum for a savings account for safer parking. But I caution you, consider holding this for a long period because the price could drop in the bear market. So in order to see these gains, you would want to hold on for long term. Just some tips when you're exiting out of the market that I think are important. Number 1, keep in mind that exchanges will charge you a fee for a fiat conversion into your bank account. So make sure you know what that is. And then also if you're moving a personal wallet, either a software or hardware wallet, when you're transferring it onto an exchange, it does require a transaction fee, so you will pay for that. Also, if you're holding something long-term, get a hardware wallet. That's for safekeeping or for a lot, because there can definitely be hacks. Someone could hack into your crypto, and if it's not your personal wallet, then it's not your coin. Also, when the market is hot, sometimes exchanges can get locked up. Coinbase is well known for that in the previous bull markets. So consider having a second option or a second way to cash out. So Kraken, Crypto.com, or another exchange. And then also think about any trading is a taxable event. So when cashing out, you have short and long-term capital gains that you have to consider, and you'll need to report this on your taxes. You also may want to consider taxable harvest loss to help with what you owe at the end of the year. So if you have lost a significant amount in a coin and you decide to sell it, that may be a harvest loss to deduct what you owe. But again, consider that you really need to consult your tax professional to ask about any or all of these. Okay, now putting it all together. Number one, use your market indicators. The trend is your friend. We know that red flags for market indicators, we want to look at the halving cycle. We want to look at retail investor flood-in. When altcoins significantly outperform Bitcoin, we know that those could be signs from the previous cycles that it's time to get out. And then learn how to take profit. Retail fan, they have no exit plan, so do not let the smart money unload on you. Establish your goals and then what you'll spend on your profits. That does help you take profits. And then taking profits, you really want to sell high, but ladder down when the prices rise to the sky. You don't have to cash out at the very top, but a slowly DCA strategy and cashing out, laddering out does help you preserve your assets. All right. Again, you can follow us on SheNodes, on X, on Insta, and there's our email.